Let's start our session. Today we are going to discuss and especially we are going to introduce a new chapter, that is LKAS 12. Sometimes we call it IAS 12, income taxes. So it's the first session. Today we are going to discuss very fundamental things about this standard. Our focus is basically today is current tax. So let us understand some terminologies used in this standard. So accounting profit, so it's a profit or loss for a period before deducting tax expenses. As you know how to calculate net profit. So when you calculate net profit, you follow accounting rules and regulations. It means especially you follow accounting standard, accounting concept and accounting principles. And first you will get gross profit, and you add some other income, and you deduct some other expenses like admin expenses, selling expenses and other expenses, and you will get earning before interest and tax. From that value you can deduct finance cost, and you will get profit before tax, and you deduct income tax, and you will end up with net profit. Here accounting profit means, so it's a profit or loss for a period before deducting tax expenses. So here profit before tax. Normally when you do some calculations, when in exam paper, in exam question or any other illustration examples, so there are a lot of information will be provided you to calculate net profit, and especially with regards to income tax, the examiner or the information will be given that how much current tax for the period, right? So here our focus here is what the understanding the differences between what is accounting profit and what is taxable profit. Taxable profit, so let us discuss the definition first. So taxable profit or tax loss, is the profit or loss for a period determined in accordance with the rules established by the taxation authorities upon which income taxes are payable or recoverable. So you may encounter with a special subject called income taxes. In Sri Lankan context, the taxpayer should prepare their financial statements based on the amendments of Inland Revenue Act number 24th of 2017, income tax, right? So you might studied about that. So when you calculate net profit accordance with the amendments of the act, it's mean amendment of the rules provided by the tax authorities, that profit may be different from accounting profit. In simple terms, when you calculate net profit by following accounting rules and regulations, you will end up with accounting profit. In other hand, when you follow rules and regulations provided by local tax authorities, the profit is called taxable profit, because there are some differences. Some expenditures are not allowable expenditure in their tax amendments, tax rules, but which expenses are allowed in accounting profit. When you calculate accounting profit, some expenses are allowed to deduct as an expenses, but when you calculate taxable profit, some expenses are not allowed as a deduction of expenses. So there are differences, right? So keep it in your mind, when you calculate profit based on their rules and regulations of tax authorities, that profit will be taxable profit. When you follow accounting rules and regulation, especially accounting standard, to calculate profit, so that is called accounting profit. If you are not clear about the differences between accounting profit and taxable profit, you never ever understand this chapter. This is standard. So it's very important to understand the differences between accounting profit and taxable profit. I hope you have studied income tax in another subject. Hopefully in the last semester you have studied. Right. Tax expense and current tax. Tax expense and current tax. So tax expense is the aggregate total amount, an aggregate amount included in the determination of profit or loss for the period in respect of current tax and deferred tax. So here the tax expense equal current tax plus deferred tax. So what do you mean by current tax and what do you mean by deferred tax? So we will devote a significant amount of time to study about deferred tax. So current tax is simply when we are going to calculate the taxable profit. When we are calculate the taxable profit based on their rules and regulations established by or provided by local tax authorities, we will get some amount of profit. That is called taxable profit. So the taxable profit will be in the process of calculation of income tax. So there are some rate, right? This rate is differ based on the level of income of an individual or of a company. So for a company, it's a single digit. So 24%, or 16%, or 20%, or 30%, right? So easily we can calculate taxable profit into corporate tax rate. So that equal current tax. So what is deferred tax? So you may calculate income taxes based on accounting profit, and you may find income tax based on taxable profit. So there are some differences between these two profits. So these differences arises due to deferred tax. We will discuss in much detail in the forthcoming sessions. So now you better understand what is current tax. So current tax is the amount of income tax payable in respect of taxable profit for the period. Here, so very clearly explained, right? The current tax is payable based on in respect to taxable profit. This taxable profit. So total tax equal maybe total tax or total tax expense equal current tax plus deferred tax. So current tax plus deferred tax equal to the accounting profit into tax rate. Right? That's a different scenario, right? So basically, why do they calculate deferred tax? So when you calculate income tax based on the accounting profit, that will be differ when you calculate income tax based on the taxable profit. So that difference will be arises. So that will be regarded to deferred tax. When you calculate income tax based on the taxable profit, that is called current tax. Recognition of current tax liabilities and current tax assets. So liabilities, very simply, so we have already discussed in LKAS 1 and framework. Liability means, so there's a probable future cash outflow. There's a probable economic outflow from the entity. So it's mean, in the tax point of view, we have to pay tax in future. We have to pay tax in future. Or we have, the entity has paid less amount of tax in the current year. The entity has paid less amount of income tax in the current period. It's mean, in future the entity should pay more tax. So that time it's coming under current tax liabilities. And other side, another extreme, entity may pay more income tax than the actual amount of tax, more, right? So that time the company, the entity made advance payments. It's like an advance payment. This advance payment is called what? It's coming under current assets. Current tax assets. It's coming under current tax assets. So these differences arises due to temporary differences. The current tax liabilities and current tax assets arises due to temporary differences. So there are two temporary differences: taxable temporary differences and deductible temporary differences. So the reason for current tax liabilities is taxable temporary differences, and for the reason for current tax assets, deductible temporary differences. We will discuss in detail. So current tax assets. So current tax for current and prior periods shall, to the extent unpaid, be recognized as a liability. Here current tax for current period. So current tax for this period and previous period. Say we are in 2021, and so income tax for this period and income tax for the last period or previous period sometime is unpaid. If it is unpaid, then it's become a liability. It's become a unpaid. So in simple term, any unpaid expenses coming under liability, especially current liability. So in point of tax, so current tax for current and previous period, if it is unpaid until it's paid, be recognized as liability. LKAS 12 requires any unpaid tax in respect of current or previous period to be recognized as liability. So it's a basic principle has applied. If it is unpaid, it is payable, then it's fall under current assets, current liabilities. If amount already paid, is kind of advance payment. If the amount already paid in respect of current and prior period exceed the amount due for those period, the excess shall be recognized as an asset. So here very clearly state that if the entity paid in advance, or if the entity paid larger than actual amount, then that amount should be recognized as current tax assets. Any excess tax paid in respect of current or prior period, or what is due should be recognized as an asset. So there are two different angles. The first one is advance payment. The second paragraph is talk about additional payment, excess payment. So both of them are kind of what assets, current assets. So it's regards to income tax. So therefore we define under current tax assets and current tax liabilities. Here you might end up with you may encounter with this kind of examples when you study in previous semester, so especially in company accounts. Here illustration is given to you similar to that. In 2018, Darton company had taxable profit of 120,000. In the previous year, 2017, income tax on 2017 period had been estimated 30,000. The corporate tax rate is 30%. Here calculate tax payable and charge for 2018 if tax due on 2017 profit was subsequently agreed with the tax authorities as condition number 1, situation 1, 35,000, situation 2, 25,000. So any under or overpayments are not settled until the following year tax payment is due. Here 2017 current tax will be revealed in 2018. 2018's current tax will be revealed in 2019. So like that. So how to handle this? Here let's now calculate the current tax. How much? 120 into 30%. How much?
36,000.
36,000. Right. 36,000. And the income tax on 2017 profit had been estimated. So this 30,000 is paid or payable? This 36,000 is paid or payable? Yeah, it's a payable. So it's coming under current tax liability. Here in the previous year 2017, income tax on the period had been estimated 30,000. Income tax 30,000 is estimated value. This is one estimated. This is the estimated value. But actual amount is 35,000. Actual amount is 35,000. Income tax in the previous period. Here is a profit, right? Right. Then how much? Estimated profit is 30,000, but actual is 35,000. Then over provision or under provision? Over provision or under provision? Which one? It's a under provision, isn't it? It's a under provision. So therefore we have to pay more. How much? 5,000 is a under provision. So we have to add this 5,000 with this figure. How much total? How much? How much total?
41,000.
41,000. So 40,000 41,000 is payable as a current tax, right? So current tax as current tax liability is payable, right? Current tax liability payable. So in this case, so actual payment is 25,000, but estimated value is 30,000. Then how much? So overpayment, overpayment, that is 5,000, right? Then how much? 36,000 minus 5,000 equal 21,000, right? So 21,000 will be considered as current tax liability. Right, 36,000 minus 5,000. Right, so here answer also here attached here. You can find the answers. So now let us discuss recognition of current tax liabilities and current tax assets. How to recognize. So let us discuss about current loss, tax losses. Tax loss. We talk about tax loss. So normally when an entity earn income, earn profit, so the entity should pay income tax to the government. So what will happen if an entity encounter with losses? So what's the treatment? So what's the logic here? When entity earn profit, it should pay tax on that profit to the government. If the same entity encounter with losses, so what will be the treatment? So it's mean the government should pay something. The government should pay something to the entity. But the actual scenario is, in practical, government not pay anything to the taxpayer, those who are facing loss. So, but what actually government do is, in future, when they pay income taxes, they can give some kind of credit. It means they can deduct, they can offset the previous losses in the future period. The benefit relating to tax losses that can be carried back to recover current tax of previous period shall be recognized as an asset. Yeah. So when an entity earn profit, it should pay income tax to the government. So it's tax liability. It's a tax liability. In other hand, if the company encounter with losses, government should pay to the entity. So it's an asset. So the tax losses make assets. The tax losses will create current tax assets. So the benefit relating to the tax losses. So tax loss is kind of a benefit. The benefit relating to tax loss that can be carried back to recover current tax of previous period shall be recognized as an asset. Right? The current tax losses will be recognized as an asset. Recognized as asset. So when a tax loss is used to recover current tax of a previous period, an entity recognizes the benefit as an asset in the period in which the tax loss occurs, because it is probable that the benefit will flow to the entity and the benefit can be reliably measured. So it meets the criteria to recognize as an asset. So it has two things. There's the probability of the benefit, and it can be reliably measured. So it can be recognized as an asset. So when it should be recognized? At the period in which the tax losses incurred. From that period onwards, it should be recognized as income, as a tax assets, as a current tax asset. So it can keep until it fully recovered against tax payable in the future periods. IAS 12 or LKAS 12 also requires recognition as an asset of the benefit relating to any tax losses that can be carried back to recover tax of a previous period. So this is acceptable because it is probable that the benefit will flow to the entity and it can be reliably measured. So this tax loss meet two criteria, that's probable economic benefit and the benefits measure reliably. So therefore it can be recognized as an asset. Right. In 2013, Aramo company paid 50,000 in tax on its profit. Right. In 2017, Aramo company paid 50,000 in tax on its profit. In 2018, the company made tax loss of 24,000. Tax loss of 24,000. So the previous period is 2017, where tax paid is 50,000, and 2018 is the current period. In the current period, they made loss 24,000. The local tax authority rules allow the losses to be carried back. So the carried back to offset against current tax of prior period. The tax rate is 30%. Here the tax amount is 50,000. Here loss is 24,000. So how much tax loss? Asset, how much? 24,000 into 24,000 is a profit. Tax rate is 30%. Then how much? If it is a profit or loss, how much? 7,200. If the entity earn profit this year 24,000, it should pay tax to the government 7,200. But the company end up with loss. Therefore, the government should pay to the entity 7,200. Right? So the double entries for the recognized tax charged and liability for 2018. So what is the double entry here? It's an asset, no? It's an asset. Yes or no? It's an asset. So it should be disclosed in balance sheet. And when you pay income tax, it's an expenses. When you pay income tax, it's an expense. You can charge that tax expenses in the PL account, income statement. So income statement, PL account is debit, and tax payable is credit. Normally you write double entries for tax expenses. This is tax loss. It means it's a benefit. It's an asset. It's not a liability. It's kind of a benefit. So it's kind of a profit to the company. It's mean, so in other way, it's kind of income, so it should be credited in the PL account, income statement, and it should be credited in the asset, in the balance sheet. So double entry will be here. What current tax assets. So it's an asset, so therefore 7,200, and PL account credit 7,200. Yeah, the answer also here. So tax recoverable, right? Tax recoverable is an asset, 7,200, and tax repayment, so statement of PL account is 7,200, right? Measurement of current tax asset, measurement of current tax liabilities and current tax assets. Measurement of current tax liabilities for the current and prior period is very simple. So they are measured at the amount expected to be paid the tax authorities. Current tax liability. So it's very simple, right? So when you follow the rules and regulations supplied by the tax authorities, you can find taxable profit, from which you can calculate the tax amount. So that is equal current tax. So they measured at the amount expected to be paid the current tax authorities. So how much you have to pay to the income tax department of Inland Revenue. Recognition of current tax. So normally current tax is recognized as income or expense and included in the net profit or loss for the period, right? So when you do the calculations, when you prepare income statement, if you pay income tax, so it will be deducted in the income statement from the profit. If it is unpaid, you can charge it as liabilities in the balance sheet. Anyhow, there are some instances you are unable to recognize that income taxes. First one, the business combination, merger and acquisition, consolidation, acquire, the holding companies acquire as subsidiary. So in that instances, the tax benefit cannot be recognized as asset. Here, normally current tax is recognized as an income or expense and included in the net profit or loss for the period, except two cases. First one, tax arising from a business combination is treated differently. Tax assets or liabilities of the acquired subsidiary will form part of goodwill calculations, right? So that amount will be taken at the time of goodwill calculations, so therefore that will be set off. And second instance, tax arising from transaction or event which is recognized directly in equity in some or different periods. So equity method you might studied about it. So how to disclose the current tax assets and current tax liabilities, and income tax paid, current tax and deferred taxes. In statement of financial position, the tax assets and liabilities should be shown separately from other assets and liabilities. So when you look at balance sheet of any entity, you can find that separate line of item for tax. There should be a separate line of item. Current tax assets and liabilities can be offset, but this should happen only when certain conditions. So if you find current tax assets and current tax liabilities, you can set off, you can cancel out each other. Say for example, tax liability is 100,000, tax asset is 80,000, so you can write up as 20,000 as a current tax liabilities. So it's kind of set of offsetting. So current tax assets and liabilities can be set off offset, but this should happen only when certain conditions apply. First condition, the entity has a legally enforceable right to set off the recognized amount. 2, the entity intends to settle the amount on net basis or realize the assets and settle the liability at the same time. The tax expense or income, the tax expense or the tax income relate to the profit or loss from ordinary activities should be shown in the statement of profit loss account, not in the other comprehensive income. Right, so we have to focus mainly on deferred tax. So we will play with a lot of calculations under the deferred tax. So deferred tax assets, deferred tax liabilities, temporary taxable differences, deductible temporary differences, permanent differences, temporary differences, tax base, and carrying amount. So there are a lot of stuffs we are going to discuss. So we will start up with your fresh mind. So I kindly request you to follow all the slides I have supplied you, and we will meet in the next class.